at understanding credit scores. The basics in our journey towards better credit. The first step is to grasp the foundational aspect of financial health. Credit scores. Understanding credit scores is crucial, as these numbers significantly influence our financial opportunities and decisions. You might wonder, what exactly is a credit score? A credit score is a numerical representation of your creditworthiness, which lenders use to evaluate the risk of lending you money. It typically ranges from 300 to 850, with higher scores indicating lower risk. Now, let's delve deeper into the critical elements that comprise credit scores, their importance, and how they shape your financial future. The first element to consider is the credit report, which is an essential tool that credit bureaus utilize to derive your credit score. This report contains details about your credit history, including your borrowing and repayment behavior. Creditors and lenders report to the bureaus, providing information on your accounts, payment history, outstanding debts, and any public records such as bankruptcies or late payments. It's vital to keep track of this report periodically to ensure its accuracy. Why? Because any inaccuracies could significantly impact your credit score. Next, let's examine how credit scores are calculated. There are 5 main factors that contribute to your credit score, each carrying a different weight. Payment history 35%, amounts owed 30%, length of credit history 15%, new credit 10%, and types of credit in use 10%. This breakdown emphasizes the importance of making timely payments, maintaining a low credit utilization ratio, and managing various types of credit. To visualize this, think of a pie chart where each slice represents one of these factors contributing to your overall score. In this chapter, one practical activity to undertake is to obtain a free copy of your credit report from annualcreditreap.com. Review the details in your report carefully. Make a list of any discrepancies, such as incorrect account information or unfamiliar accounts, that you may notice. This exercise is an excellent first step in understanding your credit profile and ensuring the information being reported is accurate. Beyond understanding your credit score and report, recognizing the importance of good credit in your life is paramount. A better credit score can open doors to opportunities that may otherwise remain closed. For example, if you aim to purchase a home, a higher credit score can result in lower interest rates, saving you significant amounts over the life of a mortgage. Similarly, if you plan to finance a car or take out a personal loan, your credit score will directly influence the terms and conditions offered to you. In practical terms, good credit acts as a financial passport, granting you access to better rates and terms, which can impact your savings in the long run. So, how do you move towards achieving and maintaining a strong credit score? The answer lies in cultivating good credit habits. Start by making payments on time. Whether it's your credit card bills, student loans, or utility payments, ensure that you pay your bills on or before their due dates. Setting up reminders or automating payments can help you stay disciplined. Additionally, keep your credit utilization ratio low, ideally below 30%. This means if you have a credit card limit of $1,000, aim to use no more than $300 of your available credit. This practice will positively affect your score over time. Furthermore, it's essential to maintain a diverse mix of credit. Consider having a combination of revolving credit like credit cards and installment loans like auto loans or mortgages. Lenders like to see that you can manage various types of credit responsibly. However, be cautious not to open numerous new accounts at once. Each application can lead to a hard inquiry, which may temporarily lower your score. Instead, plan your credit needs strategically and apply sparingly. Finally, remember that improving your credit score is a marathon, not a sprint. There are no quick fixes. Staying informed and proactive will set you up for success. Make it a routine to monitor your credit score regularly through services that provide updates and alerts. Many credit card companies also offer free credit score tracking as part of their benefits. As you embark on this journey toward improving your credit, remember that gaining knowledge is your first step. By understanding your credit score and the factors that influence it, you'll be equipped to make informed decisions and take actionable steps toward achieving your financial goals. In the following chapters, we will explore specific strategies and techniques that can help you boost your credit score by 100 points or more. So, buckle up, your path to better credit starts here. Chapter 2. The factors affecting your credit score. Understanding your credit score is pivotal in your journey to better credit. In this chapter, we will delve into the various factors that impact your credit score, offering a comprehensive look at what influences your financial standing. By grasping these elements, you can take informed steps to elevate your score, potentially by 100 points or more. First and foremost, it's essential to recognize that credit scores typically range from 300 to 850, with higher scores indicating better credit worthiness. Credit scoring models, notably FICO and VantageScore, evaluate multiple factors to arrive at your score. Let's break down these key components, making it easier for you to understand how they play a role in your overall credit profile. The most significant factor in your credit score, accounting for approximately 35%, is your payment history. It reflects whether you have made on-time payments on your debts, including credit cards, loans, and mortgages. Late payments, charge-offs, and bankruptcies can have a detrimental effect on your score. To improve your payment history, establish a habit of making payments on or before their due dates. Consider setting up automatic payments or reminders to avoid missed payments. If you have past delinquencies, focus on rebuilding trust by making payments consistently over time. Next, the amounts owed contribute another 30% to your credit score. This factor examines your credit utilization ratio, which is the percentage of your total available credit that you are currently using. For instance, if your credit limit is $10,000 and you have a balance of $3,000, your credit utilization is 30%. Aim to keep this ratio below 30%, although lower utilization is even better. You can achieve this by paying down existing debts, avoiding new charges, or requesting an increase in your credit limit. Practice tracking your spending and payments to maintain a healthy credit utilization ratio. The length of your credit history constitutes 15% of your score. This factor assesses how long your credit accounts have been active, including your oldest account and the average age of all your accounts. A longer credit history is favorable as it provides lenders with a clearer picture of your financial behavior over time. While you cannot change the length of your history in the short term, you can work on maintaining older accounts, even if you don't use them regularly. Closing old accounts can shorten your credit history and negatively impact your score. Instead, keep them open and manage them wisely. Next, new credit inquiries account for about 10% of your credit score. Each time you apply for a new credit account, a hard inquiry is made on your credit report, which can temporarily reduce your score. Though occasional inquiries are normal, multiple inquiries within a short period can signal to lenders that you might be facing financial difficulties. To minimize the impact of inquiries on your score, limit new credit applications and space them out over time. When shopping for interest rates, do so within a 30-day window to ensure that it counts as a single inquiry. Finally, the type of credit you have, known as credit mix, also makes up 10% of your score. Lenders favor borrowers with a diverse range of credit types, such as installment loans like mortgages and car loans, and revolving credit like credit cards. Building a healthy mix of credit can enhance your score over time. If you lack certain types of credit, consider diversifying your accounts. However, avoid opening accounts solely for the purpose of improving your credit mix, as the impact of inquiries can outweigh the benefits. To put this knowledge into practice, start by requesting a copy of your credit report from each of the 3 major credit bureaus: Experian, TransUnion, and Equifax. Examine your report for any inaccuracies that could be dragging your score down. Dispute any errors promptly, as correcting your report can give your score a significant boost. Remember, you are entitled to 1 free credit report annually from each bureau through annualcreditreport.com. As you assess your credit history and identify areas for improvement, it's crucial to create a plan of action. Consider taking advantage of credit monitoring services, which can help you track changes to your score and alert you to any potential issues. Set realistic goals, such as reducing your credit utilization below 30% or making timely payments for 6 consecutive months. Celebrate your progress, however small, as incremental improvements can lead to substantial gains over time. Finally, surrounding yourself with the right resources can make a significant difference in your credit journey. Look for reputable financial blogs, podcasts, or courses focusing on personal finance and credit health. Tools like budgeting apps can assist you in keeping track of your spending and managing your payments effectively. The more informed you are, the more empowered you will be to boost your credit score. In conclusion, understanding the factors affecting your credit score is the first step towards improving it. Take control of your financial future by actively managing your payment history. Amounts owed, credit history length, new credit inquiries, and credit mix. By implementing the strategies outlined in this chapter, you are on your way to achieving better credit health and ultimately greater financial freedom.